Hi everyone. In today's class, we are going to be dissecting operating statements, one of the topics in performance management. Okay, so what do you then understand by operating statements? Of course, operating statement is the same thing as income statement or budget statement or historical statement. Whatever the statement that it is being called is the same thing. So the income statement represents the statement that shows the operating performance of an organization for a specified period, all right, for a specific or specified period, usually a year. Just like you have the income statement, profit or loss account in the financial account or financial reporting. So for management reporting purposes, the operating statements is the statement that shows the operating performance of an organization for a particular period. Now, when you talk about operating performance, it's simply saying the income statement, the net profit or loss. So, in financial reporting or financial accounting, the POL, profit or loss account, is an account or a statement that that measure the performance of an organization. So, profit generally is a measurement of performance. All right. So, of course, there are basically two methods of presenting income statements, including one, marginal costing method, then two, absorption costing method. So let's pick each of them and explain the concept. So we start with the marginal costing approach. What do you understand by marginal costing approach? The marginal costing approach is a concept that charge all the direct cost of production, including direct material, direct labor, direct expenses, and variable parts of production to the unit cost of a product. So in the determination of unit cost of a product, say for example, you have a marker or a pen, you want to determine the unit cost of that pen or marker. So any cost that can be directly traceable or attributable or specific to the production of the marker are variable costs. They are direct cost. They are marginal cost. So is either you call it direct cost, variable cost, or marginal cost. It's the same thing. All right, because they are directly related to production, and that's why it is called direct cost. So when you want to determine the unit cost of a product, only the costs that are related to the production, that are directly related to the production, that are variable in nature, are the one that you will consider. So that is the meaning of marginal costing concept. However, when you talk about marginal costing concepts, it's an accounting system whereby the fixed cost incurred, okay, the fixed cost incurred during the period are written off fully from the aggregate contribution. This simply means that anytime you want to determine profits, so in order to get the profits, you are supposed to deduct the period cost. Okay, all the fixed cost incurred during the period, you less it from the aggregate contribution for you to arrive at a profit. So that's what that simply means. However, this marginal costing technique is designed principally to support managerial decision. Okay, it is designed to aid managerial decision. This will then allow management to concentrate on the courses of action that are critical and strategic to the business success in achieving a targeted organizational goal. All right. So that is marginal costing concept. The advantages and disadvantages, you can read them through. Now, anytime you want to prepare the income statement using marginal costing approach, you have to consider there are some features or points you must take into consideration. All right. So using marginal costing method or using marginal costing approach, opening and closing stocks are valued at total cost, at total variable cost per unit. Okay, I will repeat. Whenever you want to prepare income statements using marginal costing approach, opening and closing stocks are valued at direct cost, variable cost, or marginal cost per unit. All right. So what am I trying to say here? Say for example, let me look for a space. Say for example, let me use this. So we are given opening stock of 1,000 units. Okay, we are given opening stock of 1,000 units. So what I need to do, this is opening stock, all right, of 1,000 units. So all I need to do is to go into the question. I will add up all the variable cost of production. For example, I'll pick direct material. Let's say direct material is 5 naira. All right. I'll pick direct labor. Let's say direct labor is 3 naira. I'll pick direct expenses. Say this one is 2 naira. So I will also pick variable production overhead per unit. Let's say this is 4 naira. I will then add everything together. This will give me 14 naira. This is 14 naira. So this is called total variable cost per unit. This is total variable cost. Okay, let me rewrite that. Total variable cost per unit. So once I will now multiply this 14 naira per unit, I will multiply with 1,000. That will give me opening stock. That will give me total opening stock. Okay, and that's why we're trying to say here that opening and closing stocks are valued at total variable cost per unit. All right, total variable cost per unit. So all you need to do is to add up direct material per unit, direct labor per unit, direct expenses per unit, and variable overhead per unit. Add them together. That will give you total variable cost per unit. Then you multiply with opening stock. If you want to do closing stock, after you have done your working for closing stock, say for example, you have a closing stock of 200 units. Okay, so all I need to do again to get my total value, to get the value of my closing stock, I need to multiply 200 unit multiplied by 14 naira. So that's the point where I'm trying to communicate there. So in the number one feature that you need to take into consideration is that opening and closing stocks are valued at total variable cost per unit. Okay. Then the next point is that fixed production overhead is written off fully from the aggregate contribution in the determination of net profit. So what this simply means is that whenever you want to determine net profit or loss, so you are expected to deduct the fixed production overhead should be part of your period cost, because your period cost is more than fixed production overhead. But what this point is trying to communicate is the fact that you don't charge fixed production overhead to the unit cost of a product. Rather, it should be written off fully from the aggregate contribution in arriving at the net profit. Then the next point is that fixed production overhead is based on the budgeted output, all right? And it is constant within the relevant range. So in this case, the fixed overhead is determined by multiplying the budgeted output with the fixed overhead absorption rate. Now, whenever you want to determine, because we are saying that fixed production overhead is not part of production cost. So what that means is that it's going to be, since it's going to be constant, and as a result, it must be based on the budgeted output. I will go to the question, what is the budgeted output given to me? That will then multiply the fixed overhead absorption rate on the budgeted output for me to have my fixed production overhead. And throughout the period, okay, period 1, period 2, period 3, whatever period that is given, the fixed production overhead will be constant. Okay, the fixed production overhead will be constant because it is based on the budgeted output. All right, so that is that. Then the next one, number 4 point that you need to take into consideration is that marginal costing approach does not consider overhead absorption. Okay, marginal costing approach does not consider overhead absorption. Whether there is under or over absorbed overhead, marginal costing has nothing to do with that. It is only absorption costing that does that. Then the next point is that fixed production overhead is not included in the production cost. So I've already said that. Then the last point is that marginal costing make use of contribution unlike absorption costing that uses the or recognizes profit. Okay, sorry, gross profit. So what is in the format, when you deduct the cost of goods sold from the sales, what you are going to have thereafter is the cost of sales or cost of goods. Is the contribution. Once you less cost of sale from the from the revenue, the difference will represent a contribution under marginal costing approach. Whereas under absorption costing approach, the difference will represent a gross profit. Okay, so these are some of the features you need to take into consideration when you are preparing the income statements using marginal costing approach. So let's talk about the formats. Okay, let's talk about the formats that you are supposed to use whenever you want to prepare income statement. Now, once you are able to master these formats, then you have no issue. No matter how big is the question, you are going to arrive at the right answer. Okay, you arrive at the right answer, at the appropriate or correct answer. Now, when you want to prepare the income statement, remember, we said that income statements represents the statement that shows the operating performance of an organization. This is the performance we are talking about. Net profit or loss is the performance of the organization. So we want to prepare a statement that will show this particular performance. And then, of course, for us to be able to achieve this, the first item on the list will be sales value. Okay, how do I determine the sales value? I will go to the question, what is the number of units sold? Therefore, number of units sold multiplied by selling price. I will add the two of them together. That will give me my total sales. Then after sales, the next thing I need to consider is production cost. Remember, in our definition of marginal costing approach, we said that marginal costing approach is a concept that charge the total variable cost of production to the unit cost of a product, direct material, direct labor, direct expenses, and variable overhead. Now we want to determine it. So under this, all those key points, all those points I just mentioned earlier on, about 6 of them. So this is the point, this is time for you to put them into practice. Therefore, the first item under your production cost is the opening stock. Now, in the previous year, say for example in 2023, we're in 2024. In 2023, if the closing stock in 2023 is 1,000 units, so as you are moving to 2024 January, all right, it will become opening stock. Therefore, for me to value the opening stock, I will pick the units unsold in the previous year, then I will multiply with the total variable cost per unit, then I will come and post. So there is no stress in this one. If you are not given the opening stock, just ignore. Then the next item will be the direct cost, the direct material cost. For me to get the direct material cost, all the costs you have under the production cost must relate to number of units produced. You are going to multiply them with the number of units produced. Okay, it is only the sales, okay, where the selling price will be multiplied with the units sold. Every other items under all the items under the production cost must be multiplied with the number of units produced. Therefore, for the direct material cost per unit, I will multiply. So for me to get the total direct material cost, I will multiply the units produced in that year. I will multiply with direct material cost per unit. Then I will post. There is no need for you to do working for this kind of a thing. Just use your calculator, all right, and you get the answer. Again, the next item is direct labor cost. So how do I get my direct labor cost? It's very simple. If in the question you have been given direct labor cost per unit, then the direct labor cost per unit multiplied by unit produced, then I will come and post. The next item is direct expenses. Okay, direct expenses. So if in the question you are given direct expenses, just multiply direct expenses per unit by the unit produced. Then also I will post. If you are given variable overhead per unit, variable production overhead per unit, then variable production overhead per unit multiplied by unit produced will give me total variable production overhead. I will post. Therefore, I need to add up all the items together. Once I add them together, that will give me COGS. COGS simply means cost of goods available for sale. cost of goods available for sale. So it is all these goods now, the COGAs that the company will take to the market to sell. All right. Of course, it is possible that not all the goods taken to the market are being sold. Therefore, there will be closing stock. All right. There may be closing stock. So as a result, for me to get the cost of goods sold, the cost of sales, the actual cost of sales. So all I need to do is to deduct the closing stock from the cost of goods sold. Therefore, I need to go and value my closing stock. I need to go and value my closing stock. Let me check if I have the format for calculating closing stock here. If not, I will just demonstrate that for you. How to calculate closing stock. Yes, it's there. Okay. Valuation of closing stock. Valuation of close. Okay, let's do it this way. Let's do it this way. When I finish talking, when I finish explaining absorption costing method, then I will come back to the how to value closing stock. So let's go back. Let's go back. Okay. So once I get my, I will go ahead and calculate my closing stock. Once I get it done, then I will come and less from the COGAs. The difference will now give me cost of sales. This is the cost of sales. So immediately after cost of sales, there are some costs that are variable in nature, but not related to production. Okay, there are some costs that are variable but not related to production. For example, you can have sales commission, you can have selling and distribution expenses. All right, you can have variable admin expenses. So any expenses that is variable but not related to production are what you are going to put under the variable non-production cost. So all you need to do is to add it to the cost of goods sold. So if I have direct selling expenses, I will put it there. If I have variable admin expenses, I will add it. So I'll need to add up the three of them together. The cost of goods sold plus variable non-production cost. I will add them together. Then this will give me this number. So then I will less that number from the sales figure for me to have the contribution. Remember, we said that the difference between sales and cost of goods sold represent contribution. All right. So then after that, I need to consider period cost. And we said period costs are those costs that are fixed in nature, irrespective, they don't follow activity level, because irrespective of the number of units produced, they will not change. And that's why we said fixed costs are costs that have no sympathy for activity level. All right. So this is marginal costing approach. Remember, one of the key points that we discussed is that under marginal costing approach, the fixed production overhead is written off fully from the aggregate contribution because it is not part of production cost. And that's why we are saying fixed production overhead under the period cost, because it is fixed in nature. Then thereafter, you go back to the question, do you have fixed and selling and distribution expenses? If yes, then you had. Do you have fixed and admin expenses? If yes, then you have. Any other fixed cost that the company has incurred, so you need to consider it. You can have insurance, you can have any other fixed cost, so just add them under the period cost. Then you less, okay, you less the total period cost from the contribution. The difference will then be profit before tax. The difference will be profit before tax. Immediately after the profit before tax, you must consider income tax. If you are given tax rates, it means that you must consider income tax. Therefore, the income tax will be computed as the company tax rate multiplied by profit before tax. So whatever it is, I will just say, for example, the company tax rate is 30%. I will say 30% of the profit before tax. I will post. Then I will find the difference between profit before tax and the income tax charged. The difference will represent either profit or loss. So if the profit before tax is higher than the, of course, it must be higher than the income tax. But whatever the case may be, it could be profit or loss. So, and that's how to calculate. Marginal costing. That's how to prepare the income statement using marginal costing approach. All right. So take your time to master the format. Now let's go to absorption costing method. So we have discussed so far or the underlying concept of marginal costing approach, except the advantages and disadvantages which I asked you that you can read from the material. Okay, so let's talk about absorption costing approach. So under the absorption costing approach is a concept that charge the total cost of production to the unit cost of a product. When you talk about total cost of production, total costs include both variable costs and fixed production overheads. All right. So when you want to determine the unit cost of a product, you are expected to charge together all the variable cost of production plus the fixed production overhead. You add the two of them together, that will be the that will make up the production cost. So the absorption costing method is also known as full costing or total costing method. So it's a managerial accounting system that relies heavily on the generally accepted accounting principle for external reporting purposes. Okay, I repeat, absorption costing technique is a managerial accounting system that relies heavily on the use of generally accepted accounting principle for external reporting purposes. All right. So when you talk about fixed overhead, when you talk about fixed production overhead, there are those costs that the company normally incur in the factory. For example, the rent of the factory, the electricity, the heat and rates, the water, the utility, depreciation of the machinery, all those costs that the company will incur in the factory are what is known as fixed production overhead. All right, so that's that. Then, what are the advantages and disadvantages of absorption costing? Again, please, you have the material, so just go through them and have the understanding, especially if you are an undergraduate or you are a master, MBA or MSc student. So you need this particular requirement, this particular area of the concepts. Okay, ensure you understand the advantages and disadvantages. Now, what are the key points you need to take into consideration whenever you want to prepare the income statement using absorption costing method? So under the absorption costing method, opening and closing stocks are valued at total cost per unit. Remember, say for example, the opening stock in units is 2,000. The variable cost, total variable cost per unit is 5 naira. The fixed production overhead per unit is 3 naira. Therefore, 5 naira plus 3 naira, that's 8 naira. The opening stock in unit is 2,000. Therefore, 8 naira multiplied by 2,000, I will get my answer. That's 16,000. So that means my opening stock is 16,000 naira in value. Okay? So that's why we are saying that opening and closing stocks are valued at total cost per unit. Let me also demonstrate further. If I want to determine, say for example, I want to determine total cost per unit. So like I said, you are going to add up the direct material, whatever it is, direct labor, okay, direct expenses, variable production overhead, then fixed production overhead. I will add everything together. That will give me total cost per unit. That's total cost per unit. Okay. So that's what you are going to do. This total cost per unit, you now multiply, you use it to multiply the opening stock in unit, the closing stock in unit. And that's what we're trying to say, that opening and closing stocks are valued at total cost per unit. The second point is that fixed production overhead is considered part of a production cost in the determination of the unit cost of a product. So, based from the definition, the fixed production overhead is part of production cost. You have to include it as part of production cost. That's what this is saying. However, in this case, the fixed production overhead is calculated as number of units produced multiplied by the fixed overhead absorption rate. So the fixed overhead absorption rate will be given to you. If not given to you, then you need to go and get it by dividing the budgeted output, okay? By dividing the fixed production overhead divided by the fixed overhead, by the budgeted output to get your fixed overhead absorption rate. Once you have the fixed overhead absorption rate, then you now multiply with the number of units produced. That will give you the fixed production overhead. Then the third point under absorption costing is that, of course, absorption costing uses overhead absorption, considers overhead absorption. So when there is under or over absorbed overhead, so you are expected to adjust this from the cost of goods sold, All right. Unlike marginal costing that does not consider itself with overhead absorption, but absorption costing uses or recognizes absorption costing. All right. So again, under absorption costing method, the absorption costing method considers gross profit, unlike the marginal costing, which uses a contribution. All right, these are some of the points you need to take into consideration as far as absorption costing is concerned. But what is important is that when you want to prepare the income statement using absorption costing method, fixed production overhead must be part of production cost. Not only that, opening and closing stock are valued at total cost per unit. And then lastly, of course, any other cost, be it variable or fixed, that is not related to production, will be deducted from the gross profit. Okay, will be deducted from the gross profit in arriving at the profit or loss. Okay, so this is the format for calculating, for preparing the income statements using absorption costing approach. Again, how do I get my sales value under absorption? Just multiply the selling price, okay, with the number of units sold, then you get this number. Of course, generally you are going to have the same answer as marginal costing, the same sales value under marginal. Then I want to determine the production cost. This is the time for me to apply all the concepts that we have discussed. Therefore, I want to determine value for opening stock now. So I need to go and calculate total cost per unit, direct material, direct labor, direct expenses, variable overhead, and fixed production overhead per unit. So that will give me total cost per unit. I will then multiply with number of units with the opening stock. All right. So it will give me total value for the opening stock. Direct material cost, direct material per unit multiplied by units produced. So generally, I will have the same answer under the marginal and absorption for the direct material, direct labor, direct expenses, and variable overhead because they are related to production. So in addition to the direct costs, I also need to consider fixed production overhead because absorption costing approach considered fixed production overhead as part of a production cost. Therefore, I will multiply the fixed overhead absorption rate. I will multiply with the unit produced for that particular period. Then, of course, I will then post. I will add up everything together. That will give me cost of goods available for sales. Immediately after cost of goods available for sales, I need to go and value my closing stock. Once I have my closing stock valued, of course, remember, opening and closing stock are valued at total cost per unit. So I will less. Once I do that, I will have cost of sales. So immediately after cost of sales, I need to adjust for overhead absorption. Okay, it could be under over absorbed overhead. It could be over absorbed overhead. So we are going to discuss this. Whatever the case may be, so I will make adjustment. If I have under absorbed overhead, I will less from the cost of goods sold. If I have over absorbed overhead, I will add to the cost of goods sold. The difference is what I'm going to less from the sales value. I will less the difference from the sales value to have the gross profit. Remember, I told you marginal costing approach uses contribution, whereas absorption costing approach recognizes gross profit. So then immediately after the gross profit, I need to consider non-production costs, whether it is variable or fixed, provided it is not related to production. So you have to put it under the non-production cost. If I have variable selling and distribution expenses, I will post. If I have fixed selling and distribution expenses, I will post. If I have variable or fixed admin expenses, I will post. Add all the expenses together that is not related to production, then I will less from the gross profit. The difference is profit before tax. Once I get the profit before tax, then I need to charge tax. By multiplying the tax rate on the profit before tax, okay, the difference will now give me either net profit or loss. All right. So this is the format for calculating uh, income statement using absorption costing approach. So the next thing we need to do, like I promised, let's talk about the how to value closing stock, how to calculate the closing stock. Now, stock, like I told you, in the valuation of stock, especially the closing stocks. So the way you value closing stock under marginal and absorption costing approach are different. Therefore, for marginal costing approach, stocks are valued at total variable cost per unit, whereas absorption costing approach values stock at total cost per unit. Therefore, if the closing stock is not given directly in the question, then it can be calculated as follows. So for you to get the closing stock in unit first, so I will go to the question, am I given opening stock? If I'm given opening stock, I will come and post. If I'm not given opening stock, just put a dash. All right, just put a dash. But if you are given the opening stock in unit, you put it there. Then I will go back to the question, what is the actual unit produced for that period? So the actual unit produced, I will then add it to it. So that will give me total stock available. Okay, that will give me total stock available. Then from this total stock available, we are going to make sales. Then you need to less the unit sold. Okay, whatever the unit that have been sold during the period, I will less it from the stock available. So that will give me closing stock. So once I have this closing stock, then I need to value it. How do I value it? Remember, to get the total value of the closing stock, you are supposed to multiply the closing stock. Of course, if you don't want to use this format in table, if you don't want to use this tabular method, you can also use formula to get the answer. It's the same thing you are going to get. So just closing stock equal to opening stock plus actual production minus units sold. That will give you the closing stock. Then I need to value the closing stock. If I'm using marginal costing approach, the unsold stock that I've calculated here, this unsold stock that I've calculated, I need to multiply with total variable cost per unit. If I'm using absorption costing method, so the unsold stock, the closing stock multiplied by total cost per unit. So this is how to value a stock using absorption and using marginal and absorption costing. All right. So that's that. Let's go back to overhead costing. Let's go to overhead absorption costing. So what do you understand by overhead absorption costing? Remember I told you the other time that overhead costs are just indirect costs. They are those expenses the company will normally incur in the factory when carrying out in the production process. For example, when you want to produce in the factory, you are going to rent the space. Okay, you are going to use for the factory. You are going to incur electricity cost. You are going to incur machine cost. That machine will be depreciated annually. All right. So the cost of depreciation of the machine is part of the cost. Then not only that, the water you are going to use to run it. Okay, the insurance the company will pay for some of the machines used in the factory and some other assets you have in the factory. All those costs are indirect costs. Therefore, when you talk about overhead absorption costing, it's a method of allocating overhead costs, including all those ones I mentioned earlier on: electricity, rent, utility, depreciation to a product or service. All right. So the process of allocating indirect costs to a product or service is what is known as overhead absorption costing. Ordinarily, the actual overhead incurred or produced should be the same thing as the budgeted overhead. All right. However, if the actual overhead incurred and the budgeted overhead are the same, it means that the overhead is correctly absorbed. It means that the overhead is correctly or appropriately absorbed. But we had the budgeted output absorbed is different from the actual overhead incurred, then this may result in under or over absorbed overhead. Okay, this may result in under or over absorbed overhead. Therefore, what do you mean by under absorbed overhead? What is over absorbed overhead? So let's pick it one after the other. When you talk about over absorption simply means a situation whereby the budgeted output or the budgeted overhead is greater than the actual output or overhead incurred. Once the budgeted, okay, once the budgeted output, budgeted overhead or output is greater than actual, then this is called over absorption. This is over absorption. Okay, so the difference in this case between the budgeted overhead and actual overhead, or budgeted output and actual output, the difference is what you are going to add to the cost of goods sold in this case. So if the budgeted overhead is greater than the actual overhead, so you add the difference to the cost of goods sold, then that's over absorption. Then for the under absorption, it arises when the budgeted overhead is lower than the actual overhead incurred, or the budgeted output is lower than the actual output produced. All right. So in this case, the difference between the budgeted and the actual overhead should be deducted from the cost of goods sold. Whatever the case may be, whether it is over or under absorbed overhead, the difference should be adjusted from the cost of goods sold. So it is also possible you may not be the overhead absorption may not be given to you directly. So after you have determined, in most cases, in fact, it will not be given to you directly. You are the one that will work it out. Therefore, when you now want to you want to determine the value of the over or under absorbed overhead. So first thing first, you need to determine the difference in units. Once you have the difference in units, then you now multiply with the fixed overhead absorption rate. So this is what I'm trying to say. First thing first, I want to calculate under or over absorption. Okay, so all I need to do, I will pick the budgeted output as given to me. I'll put it there. If it is overhead, do the same thing. I will carry the actual output produced for that year. Then I will less the difference between the two. So if it is positive, it is over. If it is negative, it is under. So like I have said here, once the budgeted is greater than actual, it is called over. If the budgeted is less than actual, it is called under. So if it is over, you add. If it is under, you less. So overhead, for me to now get the overhead that I'm going to use, that I'm going to adjust from the cost of goods sold, I will just multiply the variance. This is the variance that you have here. This variance multiplied by the fixed overhead absorption rate. So once I have that done, I need to go and post it. But if in the question you are not given this fixed overhead assumption rate, if you are not given the fixed overhead assumption rate, then it is computed as projected fixed production overhead divided by the normal capacity. The normal capacity is the budgeted output. So say for example, you are given fixed overhead, fixed production overhead of 10,000, okay, 10,000 in naira or in any currency that you have. Then budgeted output, say, is 500 units. Budgeted output is 500 units. So all you need to do is to just get your fixed overhead assumption rate. Just say 10,000 naira divided by 500 units equal. So that's 20 naira per unit. Okay. The fixed overhead assumption rate is 20 naira per unit. So once I have my variance here, the variance that you have here, so once I have that, this variance will be in unit. Once I have that variance, then I will multiply with the 20 naira. So it will give me either the over or under absorbed overhead, which of course I'm then going to use to adjust from the cost of goods sold. Okay. So that is how to treat overhead absorption costing. So the next thing we want to talk about now is the reconciliation statement. Okay, reconciliation statement. Of course, you can just go through the causes. Okay, you can go through the causes or reasons for overhead absorption. Okay, reason for or causes for overhead absorption. So you can, one of the reasons for overhead absorption, what causes under or over absorption, is the fact that there could be incorrect estimates of the overhead. You know, all those overhead that the company will incur when you are budgeting it. It's not budgeting. Budget is an estimate. It's not the actual cost. So there's likelihood that based on the present information, based on the information available to the management, they can overestimate or underestimate the budget estimate. Okay, the budget figure. Say for example, the rent, so, or electricity, because they don't know the market events, market condition can make those numbers to change. The prevailing business environment can change the numbers, the budget estimate. But what is important is that there could be, once there is under or over absorption, it may well be that it's due to the incorrect estimation of the overhead cost. Not only that, when there is seasonal variation in production, you know, seasonal variation is a situation, of course, for the whole period of 12 months, there are some period where the company normally makes, high sales, okay, when the company sell more of his product. So that is, for example, you can have during the seller period, okay, more people will tend to buy a particular product than the normal month of the period. During the Christmas, again, more people tends to buy some items, all right. So the company will want to produce more of that product by that time. However, it is possible. Of course, all those things are just projection. Again, the actual may be different from what the company has projected for. So, because company may be expecting that, oh, we are approaching a Christmas period. We are, maybe the company is a textile company. It's a company that manufacture clothing. So as a result, the company has projected that they are going to make so much sales, and due to prevailing economic condition, customer do not the customer that bought the product, there were not many as expected. So that will cause a difference between what is being budgeted for and what the company actually produced. All right, then the significant changes in production method. All right, maybe the company is using labor intensive before, they now change to machine and all of that. So this can also cause, so you can read the other ones, just read this through, you have the understanding of what usually causes the overhead absorption. All right, so let's talk about variance analysis, reconciliation statement. You know, generally, when you prepare income statements using marginal and absorption costing, the two techniques will produce a conflicting operating performance. All right, the operating performance of the two techniques will be different. The reason majorly being that the reason for the difference is because of the method of valuing stock. You know, marginal costing approach value opening and closing stocks using total variable cost per unit, whereas absorption costing method value stock using total cost per unit. As a result, it is important that you have to find the difference and what is causing the difference between the two techniques. And like I said, the major difference is the different method of valuing stock. Therefore, this difference in profit before tax can then be reconciled with the difference in stock valuation under the two methods. So ideally, the difference in profit before tax should equate or should be equal with the difference in stock valuation. All right. So the difference in profit before tax must be, not even should be, must be equal with the difference in stock valuation under the two methods. So when you want to prepare your reconciliation statement, you can adopt this format. All right. You can adopt this format. So you are going to place, you don't use net profits. You don't find difference in net profit or loss. Your focus is on profit before tax. So, but if in the question you don't have income tax. You are not given tax rates. In that case, your net profit is the same thing as profit before tax. All right. However, where you have income tax, so you have to use profit before tax. You don't use net profit. So I will then go to the question. Under the absorption costing approach, what is the profit before tax? I will post it in this format. I will go to the question in my solution. I've calculated income statement using marginal costing approach. Therefore, what is my profit before tax? I will deduct. So this will give me difference in profit. I can call that one A. So if now that I've found difference in profits, I need to go and find difference in stock valuation. So for the stock valuation, the first item you are going to consider is the stock. So I will pick the stock value under the closing stock under absorption costing method. I will less stock value under marginal costing approach. So the difference will give me difference in closing stock. This is difference in closing stock. Then I will also consider difference in opening stock between the two techniques. Okay. Opening stock under absorption, opening stock under marginal. The difference between these two will give me this. So difference in closing stock minus difference in opening stock will give me difference in stock valuation. So I will call that difference as A. So at all time, A must be equal to B. And if A is equal to B, this will be equal to 0. So that means that I have reconciled the difference in the two methods. Okay, I've reconciled the two methods. So this is the way to prepare your reconciliation statement. So far, we have discussed the concept of operating statement, which I said is the same thing as income statement. Not only that, we have dissected the two methods of presenting income statements, including marginal costing method and absorption costing method. I also provided you with the key points you need to take into consideration when preparing income statement using marginal and absorption costing. We have discussed overhead absorption costing, where we talk about over absorption and under absorption. I also demonstrated for you how to calculate closing stock. Then lastly, we just discussed the reconciliation statements, okay, because the operating performance, the net profit or loss under the two techniques will never be the same, except it is accidental, it is coincidental. So for you to find the difference in the profits, you need to prepare the reconciliation statement, which will show you the difference in profit and difference in stock valuation. And I said that once the difference in profit equates the difference in the stock valuation, it means that what you have done is perfectly okay. So at this point, let's have illustration to demonstrate our understanding. Okay, to demonstrate our learning today. Let me see. Now, let me look for one with the two periods. Okay. Let's have illustration. Should I? Let me solve illustration number 1. Let me solve illustration number 1, the one with 3 periods. Yeah. So let's have one example. All right. Let's solve this one. Okay. Let me change this to red. Okay. Yes, the budget of Shakara Limited provides for the manufacture and sale of 10,000 units of local caps per month. The unit standard cost is 12 naira, made up as follows. Direct material is 5 naira, direct labor is 2 naira, variable overhead is 1 naira per unit, then fixed overhead is 4 naira per unit. When you add up everything, the total cost per unit is 12 naira. The selling price of the cap is 16 naira. Okay. Production and sales unit for period 1, 2, and 3 as follows. So the unit produced at all of these are the units produced for each period. Then the sales value for each period are also given. Production can be increased to 11,000 units without a corresponding increase in fixed overhead. So in that case, we are now asked to prepare operating statements for the 3 periods, assuming the company uses absorption costing and marginal costing. Okay, then 3, prepare reconciliation statement. So that is the question. This is a very straightforward question. However, generally questions under operating statement can be tedious, especially when you have more than one period and you are solving for the 2 techniques, and the examiner also asks you to prepare the reconciliation statement. So it will take time for you to solve, even though it's very easy to understand and straightforward, but usually it takes time, just like linear programming. So it takes time to solve. So what am I supposed to do? Examiner says you should calculate operating statements using absorption costing approach. So let's start from absorption costing. All right. So absorption operating statement, of course, we start from the name of the company. If given to you, start with the name of the company. So I want to calculate operating statements using absorption costing method. All right. Therefore, remember all those things that we have talked about by saying that, okay, under the production cost, both variable and fixed cost of production should be considered. So let's apply all those learning. Now, I will go to the question. I want to determine sales value. For the first period, first thing first, selling price is equal to 16 naira. Therefore, I want to determine sales value in period 1. I will then say 8,000 units. 8,000, let me push to the right. Okay, 8,000 units is the units sold in the first year. Therefore, 8,000 multiplied by selling price per unit is 16 naira, multiplied by 16. That's what gives me 128,000. So I will go and post 128,000. That's the 128,000 you are seeing here. Then period 2. For period 2, okay, the units sold in period 2 is 9,000. So 9,000 multiplied by selling price per unit of 16 naira. That's 144,000. So let's go and post 144,000. That's 144,000 you are seeing there. For period 3, okay, units sold in period 3 is 12,000. 12,000 units multiplied by 16 naira equal, that's 192,000. So let's go and post. That's the 192,000 naira you are seeing there. With this, I've calculated my sales value. The next thing I need to do is to determine the production cost. Remember, we are using absorption costing method. So the first item under production cost is the opening stock. I will then go to the first period, period 1. Is there any opening stock? Okay, examiner did not give us opening stock in period 1, and that's why you have a dash here. That's why you put a dash, because we are not given opening stock in units. Then the next thing I need to do, I will go to the question, do I have direct material? Yes, there is direct material. Direct material is 5 naira. So in period 1, production cost, units produced in period 1 is 10,000 units. Here is 10,000 in period 1. I will multiply that with 5 naira. Therefore, I will then say 10,000 units multiplied by 5 equal to 50,000. So I will come and post. That's the 50,000 that you are seeing here. Then let's go to period 2. In period 2, how many units were produced? 10,000 units were produced. Therefore, I will then say 8,000 units were produced. I will say 8,000 multiplied by 5 naira, because direct material cost per unit is 5 naira. So that's 40,000. All right, that's 40,000. So that's the 40,000 that you are seeing here. Okay, then I'll move to period 3. What's the number of units produced in period 3? The number of units produced in period 3 is 11,000. Okay, So I would then say 11,000, okay, multiplied by 5 naira. That's 55,000. All right. So I will then go and post. That's 55,000 naira that you are seeing here. So I've done for period 1, period 2, and period 3 for direct material cost. The next item, I will go back to the question. Am I given direct labor? Yes, there is direct labor per unit of 2 naira. So since I'm given direct labor per unit of 2 naira, then I need to calculate total direct labor cost. For me to get the total direct labor cost, in the first year, the company produced 10,000 units. All right, the company produced 10,000 units. I'll then say 10,000 multiplied by 2 naira. So that will give me 20,000 naira. So that's how you arrive at this 20,000. In year 2, the unit produced is 8,000. So 8,000 multiplied by 2 naira, that's 16,000. That's how you arrive at this 16,000. In year 3, the unit produced is 11,000. Okay, so 11,000 multiplied by 2 naira, that's 22,000. So that's how we arrive at this 22,000. I will move to the next one. Am I given variable? Am I given direct expenses? There is no direct expenses in this question. Therefore, you ignore. But you are given variable overhead. Variable overhead is 1 naira. I will multiply 1 naira by 10,000 units. I will get 10,000 naira. 1 naira multiplied by 8,000 units will give me 8,000 naira. 1 naira multiplied by 11,000 units will give me 11,000 naira. So let's go and post. So 10,000 naira, 8,000 naira, 11,000 naira, because variable production overhead is 1 naira per unit. Just multiply with number of units. Then the next thing I need to do, remember, we are using absorption costing method. Therefore, fixed production overhead should be part of a production cost. I will then go to the question, what's my fixed production overhead per unit? The fixed production overhead per unit is 4 naira. Okay, that's the 4 naira. So I will then multiply the 4 naira with the unit produced for each year. In the first year, in the first period, unit produced is 10,000 multiplied by 4 naira. Okay, that will give us 40,000. So I will go and post. That's the 40,000 you are seeing here. In the second year, unit produced is 8,000. 8,000 multiplied by 4 naira will give us 32,000 naira. In the third period, unit produced is 11,000. So 11,000 unit multiplied by 4 naira will give us 44 naira. Then I will continue from the first period first because I need to go and calculate closing stock. However, I need to add up all the numbers. 50,000 plus opening stock plus 50,000 plus 20,000, that's 70,000, plus 10,000, that's 80,000, plus 40,000, that's 120,000. So cost of goods available for sales in the first year is 120,000 naira. So I need to go and calculate closing stock now. So I need to go and calculate closing stock because it will not be given to you directly in the question. You are the one that will compute the closing stock. So let's go and do working for closing stock. Now, remember the formula I gave to you whenever you want to compute closing stock is simply closing stock is equal to opening stock plus actual production for that period, then less units sold. The difference will give you the unit unsold. Okay, so in the first period, there was no opening stock in units, so you put a dash. Then in the first year, actual unit produced was 10,000. In second period, 8,000 units were produced. In the third period, 10,000 units were produced. Then, of course, you add it up with the opening stock. This will be 10,000. Okay, let me just put 0 here. Okay, so that will be 10,000. So in the first period, 8,000 units were sold. Okay, let's go and confirm. In the first period, 8,000 units were sold, 9,000 units in the second period, and 12,000 units in the third period. So let's go and post that. Units sold. Units sold is 8,000, 9,000, as well as the 12,000. Therefore, 10,000 minus 8,000 will give me 2,000 units unsold. So in the first period, the closing stock in unit is 2,000. So as I'm moving to the second period, the closing stock in the first period will become opening stock. That's why you are seeing this 2,000 here. All right. Then 2,000 plus 8,000 will give me 10,000. 10,000 minus units sold of 9,000 will give me 1,000 units. So I'm going to the third period. At the beginning of third period, the opening stock in the closing stock in the second period will become opening stock. Therefore, 1,000 plus 11,000 will give us 12,000. 12,000 units were sold. 12,000 units were available for sale. Then, of course, there was no closing stock in the third period. So now that I've calculated the closing stock in units, I need to get the value. So to get the value, just multiply the closing stock in units with the total variable cost per unit if I'm using marginal costing approach, or total cost per unit if I'm using absorption costing approach. Since I'm using absorption costing approach as the first requirement, then in the first period, 2,000 unsold stock, that's the 2,000 multiplied by total variable cost per unit. In the question, the total variable cost per unit is 12 naira as given to us. So this is the 12 naira, total variable cost per unit of 12 naira. So in this case, I will need to multiply that with the closing stock in units. So, and that's 2,000 multiplied by 12 naira will give us 24,000. That's the first period. In the second period, we have 1,000 units unsold. Okay, so 1,000 multiplied by 12 naira will give us 12 naira. In the third year, there was no closing stock, so you ignore. That's why you put dash. Then just do you're working for everything. Do for marginal costing as well. All right. To get the total variable cost per unit, remember to value the closing stock using marginal costing approach. It must be opening closing stock multiplied by total variable cost per unit. The total cost per unit is 12 naira. And the total fixed production overhead per unit is 4 naira. 4 minus 8 minus 12. That will give us 8 naira. Or let's go back to the question. So the direct material cost is 5 naira. Direct labor cost 2 naira. Variable overhead 1 naira. When you add it together, that will give me total variable cost per unit. This 3 is the total variable cost per unit. Okay, all right, so that's that. So I will now multiply that with the closing stock in the first period and second period. So 2,000 multiplied by 8 naira will give me 16 naira. 1,000 multiplied by 8 naira will give me 8,000 naira. So let's go and post. So in the first period, closing stock under absorption is 24,000 naira. So let us go and post that. Let's go and post. So this is the 24,000 that you are seeing here. Therefore, 120,000 minus 24 will give us cost of goods sold of 96,000. So we give us cost of goods sold of 96,000. I will then go back to the question. I need to go and calculate. Remember, we are using absorption costing method. So let's go and calculate under or over absorption. Okay. So before you consider non-production cost. So let's consider under or over absorption. So to do this, you are supposed to compare the budgeted output with the actual output first. So that will take us to working number 2. Working number 2, I want to determine under or over absorption. In the first period, what is the budgeted output? Let's go back to the question. We are told that the budget of Shakara Limited provide for the manufacture and sale of 10,000 units of local caps per month. So the budgeted output is 10,000 units. And the actual output for each period, in the first period is 10,000, second period is 8,000, third period is 11,000. So I will less 10,000 units minus 10,000, that will be 0. That means in the first period, there is no under or over absorption. Then in the second period, 10,000 minus 8,000, that is positive. If it is positive, it is over absorption. Then you add to cost of goods sold. In the third period, 10,000 minus 11,000, that will give me minus 1,000. Because it is negative, that will be under absorption. I will less Okay, so all of this, you need to know it. All right then, so let's go and do workings for absorption. So the budgeted output for each period is 10,000 units. The actual production, actual unit produced for each period is 10,000, 8,000, then 10,000. Sorry, 11,000. So 10,000 minus 10,000, nothing, zero. 10,000 minus 2,000, positive 2,000. 10,000 minus 11,000, minus 1,000. So this one is over, this one is under. Okay? Therefore, of course, you still remember this formula. So it will be over. It will be over absorbed overhead if budgeted output is greater than actual. So if that, in that case, you are supposed to add. Okay, once it is over, you add it. All right, once it is over, you add. If it is under, you less. That's why you see it under in brackets. Okay. Then overhead, for me to now get the overhead in naira, I need to multiply the unit variance. All these items are the unit variance. So you need to multiply with the fixed overhead assumption rate. What is the fixed overhead assumption rate? The fixed overhead assumption rate is the fixed production overhead per unit, all right, which is 4 naira. So in the period one, we don't have any variance in the overhead absorption. So the next thing I need to do, I will go to period two. Period two, we have 2,000. Therefore, 2,000 multiplied by 4 naira will give us 8,000. In period three, 1,000 negative. So 1,000 multiplied by 4 will give us negative 4,000. So in this case, let us go and post 4,000, 8,000 for period two, 4,000 for period three, negative. So in the period one, there was no overhead because the budgeted output of 10,000 is the same thing as actual output of 10,000. Therefore, that's why you see that share, nothing. All right. But in the second period, the overhead, we have over absorbed overhead of 8,000. In the third period, we have under absorbed overhead of 4,000 minus. All right. So now let's complete period one. Let's determine the profit for period one before we move to period two. Okay, so in this case, now I need to go back to the question. If I'm given non-production cost, maybe variable or fixed non-production cost, let's go and check from the question. If you have other expenses that is not related to production, okay, according to the question, there is no other expenses, no other expenses. So that's it. No other expenses. In this case, just ignore. All right. Therefore, I will now find the difference between the cost of goods sold, 128,000, right? 128,000 minus 96,000. That's 32,000. So that's 32,000. There is no tax. Since there is no tax, my gross profit will be the same thing as my profits, my net profit. So that's 32,000. I will then move to period two. I've already determined the sales value for period two. I've also determined but I've not determined the opening stock for period two. Therefore, the closing stock of period one of 24,000 will become opening stock in period two. That's why you are seeing this 24,000 here. So you add up everything, that's 120,000. Okay, that's 120,000. 120,000 minus closing stock of 12,000 naira we have calculated before. All right, because we have closing stock of 12,000. Let's confirm it. Yes, for period two, closing stock is 12,000 naira under absorption. Okay. Yes, so when you less 120 minus 12,000 will give us 108,000. So we've already determined the in the second period we have over absorption, overhead absorption. So in this case, you are supposed to add it because it is over. You add it to cost of goods sold. That will be 116,000. 116,000 minus 144,000. You have a difference of 28,000, which represents gross profit or net profit since there is no tax. We then go to the third period. In the third period, the closing stock in the second period of 12,000 will become opening stock in the third period. Add everything together, we get 144,000. Okay, we get 144,000. So in the third period, we have under absorbed overhead of 4,000. So 144 minus 4,000 will give us 140,000. 140,000 minus 192,000 will give us 52,000. Now that we have the 52,000, what else do we want to do? Of course, we have determined profit under this. We need to go ahead and determine income statement using marginal costing approach. Okay, so let's go and do marginal costing. Number 2, operating statement using marginal costing method. So the sales value under absorption will be the same thing as sales value under marginal costing approach. Again, the opening stock in year 1, in period 1, there was no opening stock. That's why we put a dash. However, the same direct material cost we have under absorption costing method is the same thing that we have here. Just multiply the direct material per unit with the unit produced. Now, you can see that under the production cost, we did not consider fixed production overhead, because fixed production overhead is not part of production cost using marginal costing approach, because it should be written off fully from the aggregate contribution. So when you add up, that's 80,000 naira. So closing stock, we have already valued closing stock on using marginal costing approach. All right, our closing stock for period 1 is 16,000 under marginal. For period 2, it is 8,000. So 16,000. That's the 16,000 you are seeing here. So 80,000 minus 16,000 will give us 64,000. So this 64,000, it is called cost of goods available for sales or cost of sales. Ordinarily, immediately after the cost of sales, I'm supposed to add variable non-production costs. Any other cost that is not related to production, but they are variable, I'm supposed to add it to the cost of goods sold. But in this question, we are not given any additional expenses. Therefore, that is variable. Therefore, you will ignore. So 120,000 minus 64,000 will give us 64,000. Okay, the fixed overhead, remember what I told you, under marginal costing method, the fixed production overhead is written off fully from the aggregate contribution, and it is computed as budgeted output multiplied by the fixed overhead absorption rate. What do I mean by that? I will go to the question. What is my budgeted output? The budgeted output is 10,000 units. This is the budgeted output. 10,000 units is the budgeted output. What is my fixed overhead absorption rate? The fixed overhead absorption rate is 4 naira. So I would then say 4 naira multiplied by 10,000 units equal to 40,000 naira. Therefore, the fixed production overhead is 40,000 naira. So let's go and post. So that's the 40,000 that you are seeing here. That's the 40,000 you are seeing there. So 64,000 minus fixed overhead of 40,000 will give us profit of 24,000 in period 1. I will then move to period 2. Under the period 2, the closing stock in period 1 of 16,000 will become opening stock. That's how you are seeing the 16,000 there. Again, all the direct material costs we have under absorption, the direct labor costs we have under absorption, and variable overhead under absorption are the same. So add those numbers together, that will give us 80,000. Then closing stock in the second period is 8,000 naira. Let's go and check. Closing stock. This is the 8,000 naira in the second period. So let us go and adjust for that. Okay. Yes, this is the 8,000. So 80,000 minus 8,000 will give us 72,000. 72 minus sales of 144, that will give us 72,000. So the fixed overhead, remember what I told you, under marginal costing approach, the fixed production overhead is a cost that has no sympathy for activity level. Irrespective of number of units produced, the fixed overhead will not change. It is constant because it is based on budgeted output. All right. It is based on budgeted output. So the same fixed overhead that you have in the first period is what you are going to have in the second period and the third period. So it will not change because it has no sympathy for activity level. Therefore, 72,000 minus 40,000 will give us 32,000. So I'm done with period 2. I will then move to period 3. Again, I've already determined the sales value for period 3. For me to under my production cost, the closing stock in the second period of 8,000 will become opening stock in the first period. That's why you are seeing this. So the direct material cost, the direct labor cost, the variable production overhead under the absorption costing method that we have calculated is the same thing. Add the numbers together, that's 96,000. So in the third period, there was no closing stock. So no closing stock. Closing stock is equal to 0 in the third period, and that's why you do not have any numbers here in the third period. Therefore, what am I supposed to do? Since there is no closing stock, if there is no closing stock, what do? Put a space, just a dash, or put 0 there. So 96 minus 0 will give us 96. Therefore, 96 minus the sales value of 192, that will give us 96,000. So again, 96,000 minus period cost, fixed overhead of 40,000, that's 56,000. Now, we have computed income statements using marginal and absorption costing method. When you look at the operating performance, the profit in the first year under absorption costing method is 32,000 naira, whereas under marginal, the profit is 24,000. There's a difference of 8,000 naira. In the second period, the profit for absorption is 28. In the same period, for marginal, profit is 32. That's a difference of 4,000. Okay, difference of 4,000. In the third period, profit for absorption is 52,000. In the third period, profit for marginal is 56,000. So that's a difference of 4,000 as well. Okay, therefore, why are they not the same? Ordinarily, the profits, since it is the same income statement, so the profit for each period should be equal using the two techniques. But alas, it will never be the same because different methods are used to value stocks. Therefore, you need to go and find the difference between profit before tax for the two techniques and the difference in stock valuation under the two techniques. If the difference are equal, it means that what we have done is perfectly okay. So, examiner also asks us, you are asked to prepare the reconciliation statement. That's the third requirement. So for this purpose, I will then prepare the reconciliation statement. All right. So I've already provided you with the format you are expected to use. So you are picking profit before tax for each method. So under absorption, I will go and pick the profit before tax, which is 32,000. That's the 32,000 you have in the first period. Okay, that's the 32 here. Then under marginal, profit in the first year is 24,000, so difference of 8,000. In the second period, profit for absorption costing is 28,000. For the same period, for marginal is 32,000. Therefore, 28 minus 32 will give us minus 4,000. In the third period, profit of absorption is 52,000. Profit of marginal is 56,000, difference of minus 4,000. Okay, so now that I've found difference in profits, the next thing I need to do is to find difference in stock valuation. To do this, what am I supposed to do? I will start from the closing stock. So the difference in closing stock between the two techniques. So under absorption costing method in the first period, what do you have as closing stock? Closing stock is 24,000 naira under the absorption costing method, and that's the 24,000 naira you are seeing here. That's the 24,000 you are seeing here. Under the marginal costing in the first period, closing stock is 16,000 naira. Therefore, 24 minus 16 will give us 8,000. All right. Okay, will give us 8,000. Then I need to find this 8,000 represent difference in closing stock. This is difference in closing stock. Then I need to less difference in opening stock. So under absorption costing method, there was no opening stock. So you put a dash. Under marginal, there was no opening stock. So the difference between these two will give us nothing. 8,000 minus nothing will give us 8,000. When you look at the profit in the first year, 8,000. Difference in stock valuation, 8,000. That means this one is correct. Okay. Then I will go to the second period. In the second period, difference in profits. We've already done it. Let's do difference in the stock valuation. So in the second period, what is the closing stock under absorption? Under absorption, closing stock is 12,000 naira. So let us go and post. Okay, that's the 12,000 here. Under marginal, what is the closing stock? What's the closing stock under marginal? 8,000. All right. So that's the 8,000 here that you are seeing there. 12,000 minus 8,000 will give us plus 4,000. Then the next thing I need to do now is to determine difference in opening stock between the two techniques. So in the second period under absorption, what is opening stock? Opening stock is 24,000. Okay, let's see. That's the 24,000 you are seeing here. Under marginal, opening stock is, for the second period, opening stock is 16 naira. 16,000. That's the 16,000 that you are seeing there. So 24,000 minus 16,000. 24,000 minus 16,000 will give us 8,000. Therefore, 4,000 minus 8,000 will give us minus 4,000. Okay. Again, the difference in profit is minus 4,000. Difference in stock valuation is minus 4,000. It also means that this one is correct. Move to the next one, the third period. We are looking at stock valuation. So closing stock under absorption in the third period. Stock valuation, closing stock. Closing stock is nil under absorption. We don't have closing stock. Therefore, let's check. What do we have there? In the third period, closing stock is nil. There was no closing stock. That's why you put 0 there. Then under marginal, what do we have as closing stock? Okay. This is absorption. So under marginal, closing stock is also nil. Nothing is there. So, and that's why you are seeing this 0 here also. 0 minus 0 will give you 0. Then I will then go to difference in opening stock in the third period. So the closing stock in the second period will become opening stock, which is 12,000. For marginal is 8,000. 12,000 minus 8,000 will give us 4,000. 4,000 minus 0. 0 minus 4,000 will give me minus 4,000. Therefore, when you look at the difference in profits in the third period is minus 4,000. Difference in profit in the third period is also minus 4,000. It means that what we have done is perfectly okay. That is end of the question. That's end of the question. So you can go and try this illustration number 2 under Fernandez. So it's a complete question. So go and try it. You'll see how we are able to how I solve the question. All right. So that's it. That will be the end of today's class.